Welcome to Stock Trading Ninja, Part 3, a primer for the uninitiated. I'm Frank Bunn, your instructor. In this segment, we're going to take a really quick look at some basic indicators, as well as their specific logic, and how we're going to exploit that logic given our newfound knowledge about randomness and trends. Next, we're going to learn about impulse and its profound importance to proper trend trading. And all of this is going to give us a firm basis for learning about the universal trigger, which exploits any technical component that crosses another with alarming accuracy. So let's get right to it. With a quick look at the MACD indicator you briefly saw in the last segment. Known by its full name, Moving Average Convergence Divergence, which is quite a mouthful, the nickname is MACD for short, which is the acronym. Okay, the MACD is a trend-following oscillator. It is the difference between two moving averages, usually 12 and 26 by default, and it also consists of a moving average of itself, which is usually 9 periods in length. These are the common parameters. So the MACD has three lines then. The first is the indicator itself. The second is the slow line, which is the moving average of the indicator, or also called the signal line. And the third line is the zero line, around which the MACD and the signal oscillate. Now that we have the component logic, there are two ways this indicator produces crossover signals. When the indicator crosses either its lagging signal line or when it crosses the zero line. Quite simply, zero line crosses are nothing more than when the base moving averages, in this case the 12 and 26, cross each other up or down, given that the MACD is nothing more than the difference between the two. So when the difference between the two is positive, or over zero, it must mean that the 12-period average is over the 26-period average. And when the difference between the two is negative, or below the zero line, then it means that the 12-period average is under or below the 26. Okay, in this example, you can thoroughly understand the logic. We have the indicator plotted below the price, and the 12 and 26 moving averages used by the indicator plotted on the price itself above. You can see when the indicator crosses the zero line that the averages are themselves crossing according to the logic. What is important to note is that the indicator will always cross the moving average of itself or the signal line before it crosses the zero line up or down. Let's move on to the directional movement indicator. This is another trend following and momentum indicator. There is a positive directional index and a negative directional index, which are derivatives of the positive or negative directional movement calculation based on whether the price itself has moved up or down in the most recent interval. So the positive DI and negative DI are the quotient of an exponential moving average, which is usually 14 periods, and the average true range in price. The actual algorithmic formula is somewhat complex and beyond the scope of this training. Besides, it would put you to sleep anyway. And so plotting the positive and negative directional indexes results in an upward momentum indicator and a downward momentum indicator. And so conventionally, when they cross, either a buy or sell signal is triggered. This is how it looks on a chart. Here you can see the specific price intervals at A and C where the positive DI crosses above the negative DI, and at point B where the positive DI crosses below the DI. Now that you understand the oscillators, let's move on and cover moving averages. Most traders, even novices, have somewhat of an understanding of moving averages, which are simply averages of a certain number of recent prices, usually closing prices. Combined, these averages are plotted and appear as a moving line on a price chart. They may be either exponential or simple in nature, whereby simple moving averages is just that. The average of the last X number of interval closes. And the exponential moving average is an algorithmically weighted average which gives more emphasis to the most recent samples in the average itself. That said, here the crossover triggers occur when either one moving average crosses another or the price itself crosses a moving average line on a chart. For our purposes in this training, we're going to only be considering exponential moving averages. Here's an example of two moving averages. You can see them crossing each other up and down on the light blue shaded areas. And here's an example of price itself interacting with a moving average. You can see price randomly crossing over and under the line. Notice how it seems to hit it quite frequently. More on this later. Okay, so we need to understand this logic because these indicators will be used to help calculate the impulse we're going to learn about in the next installment. Remember, these indicator crossovers, whatever they are not necessarily trades, and they are not setups or signals either to enter or exit the market. And also remember, the truth is in the price action itself. Everything will be clear in the coming segments. Review any material covered so far if you are uncertain about any specific concepts. And if you are ready to go, I'll catch you in the next installment where things start to get really exciting.